Computer. Hello, everyone. Today we have our first lecture, and we start this course from a short excursion into finance. Today we are going to consider the key object of the finance and some opportunities for investor. It is really very essential for our understanding, and it is like input in stochastic financial mathematics. Okay, what are these key object? Let me explain this in terms of some example. The first example. Imagine that you're working with a high salary, and maybe the question is, what should you do with your money? I understand that we can say that that the one of the possibility to spend your money to consume, but maybe you would like that your money increase. What can make money increase? And if we have access to the financial market, you have possibility to deposit or invest in stocks and bonds to finance retirement, home ownership, education. But if you don't have access to the financial market, consumption, what else? So, and the second example, you are a farmer producing fruits or vegetables, it doesn't matter. What should you do? Again, if you can access to the financial market, you, for example, have possibility to use weather-related derivatives that pay when there is an unseasonable frost. But if you don't have access to the financial market, only the spot market available with the current prices, we don't use any agreement about future prices, and we are at mercy in the weather. Yes, understand? So it was example what we need to use financial markets, why financial markets exist. Okay, financial market provides the efficient allocation of resources across time and across states of nature. What do I mean? I mean across time, it is like in the first example, when we move the money from one period of time, from the present time, when you have a high salary, to the future time when we need, for example, to ownership house or something else. And across states of nature, it is, for example, it is states of nature not like seasons, yes, winter or summer. It is likely and unlikely for you states of nature. So, for example, present states of nature is likely for you because you have a high salary and you need to save this money for the other states when your salary will be less or you will be a retirement. Okay. So we need to distinguish the key object and structure of financial theory that define and explain the specific nature of financial problem. So you can see the key object like individuals, corporation, intermediates, which are connected with financial markets. And what are individuals? Individuals, it's like you and me, it is every person, and financial activities of individuals can be described by dilemma, to consume more today or to invest today and consume more in the future. Yes, okay. Corporations, it's clear. Yes, it is different companies, farms, farmers which manage manufacturing, organize a business, and what is interesting for us that they can issue different securities. No, securities are like a paper with guarantee. Money with lend and guarantee this money like bonds and stocks. And the third key object for this picture is intermediaries. Intermediaries. And what do you think? What do you think? What is this? Can you explain, for example? Give me example, intermediaries.
Maybe like brokers or
For example, brokers, it's like person, yes, but common it is like a stock exchange, yes, and the main intermediaries, it is banks, pension funds, different investment funds, yes, and their financial activities can be described like money makes money. You know this, yes. And financial market include money, cash, and markets of financial instruments. So we can speak about different financial markets. For example, bond market, option market, cash market, and so on. Okay, you need to distinguish what is underlying and what is derivative financial instruments. Underlying and derivatives. Underlying we can call it primary, and derivative we can call it secondary, and it means that the price of derivatives derive on primary price. Understand? Derivatives derive. Okay. Underlying instruments, or we can say products, include bank accounts, bonds, and stocks. Bank accounts, it's, I think, clear for you. It is if you open your bank account and put your money on this bank account and wait, for example, some time periods to take your money with rate return, yes, with percents, how we can say. Very similar to the bank accounts, it is bonds. Bonds, it is like security, and with face value. It's similar to bank account. If I explain in terms of example, for example, I put on bank account 100 euros, and I buy bonds with face value 100 euros, and after that, no, for example, every month I have rate of return from bank account, and at the end of year I can take your money back. From bonds, the situation is the similar. You buy the security with face value 100 euro, and every month you can exchange your coupon. This like coupon, it is like fixed rate return percents. And at the end of period, you can take your money. Yes, understand. So from the mathematical point of view, it is the same for us. Only bonds is associated with the coupon rate returns. And we count that the bank accounts and bonds are non-risky instruments, non-risky instruments. Stocks, it is risky instruments. More detail about it will be later. Derivative, it's financial instrument which price derive from the price of underlying assets. And for example, it is forwards, futures, swaps, options, and maybe I will explain about it later. Okay. Opportunities for investors. Today, I would like to consider three main opportunities for investor. It is deposit your money in a bank account, invest in risky asset, and to use derivatives. And we need to compare these opportunities. What is risky, what is non-risky, what is more profitable, what is less profitable, and what kind of mathematics is involved in this operation. What should you know? What kind of mathematics you should know when you make a decision what is better for you if you have some money or don't have some money but would like to earn if you have access to financial markets. Okay. So the first opportunities, it is to deposit in bank account. So we need to know the basics of the simple compound and continuous interest rate. Maybe I'm sure not maybe I'm sure that you know about it, but it is like a short reminder. So simple percent. If you have at the start, at the beginning of the time period, amount of time are sub-zero, and the annual return we denote like R little, yes. So at the end of year, it will be A0 plus A0 multiplied R, yes, if it is simple percent. But if we have several time periods, so every while it will be add this amount A0 multiplied R, and it will be A0 plus A0 multiplied R plus A0 multiplied R plus A0 multiplied R, and so on. So it is this formula for the simple interest rates. What is compound interest rate? It is when we have compounding not only on this amount But no, so for the first year, really, it is the same. If we have time period only 1 year, simple and compound interest rates, it is the same. But on the second year, we have compounding not only on this amount A0, but on the amount A0 multiplied to 1 plus R. So every time it multiplied 1 plus R, and we have this formula. Um, I I don't explain this in more detail because I'm sure that you know about it. But if I'm wrong, so please you can open uh, a lot of video or on YouTube or on internet. Okay? But what we can say, you know these formulas? Nastya.
Yes.
Yes,
Yes, yes.
yes, you know. Yes, thank you. And maybe you know about periodic. Yes, you know about periodic.
Yes,
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 yes, yes. Periodic. It is like this period we divided by m periods, just m periods, 1 year. Yes. M periods, and we have compounding every this period, but it is 1 year, for example. So in this case, if we are speaking about simple interest rate, so it will be that A0 0 multiplied 1 plus, and this return from 1 this period will be R divided by M. So it is R divided by M, but this periods is M multiplied N. How much this periods if we have not 1 years, for example, N years, yes? N years. If we have N years, M periods from this, yes, and we cross this M, and we have that for a simple interest rate, the formula stay the same, yes, the same. But for compound interest rate, it is R divided by M, like this, for one single period, and multiplied and M. So we have this formula. Okay, and I hope you know this. It is just reminding. Mhm. Oh, okay. The next, no, for us is very, very, okay, useful is continuous. It is what we use the most time. And in this case, it is like this, the amount, the number of these periods, M, yes, like on the previous picture, tends to continuity. So in this case, we use the formula for limit and exponent, and we have this formula. We know this, yes? And what is interesting, it is that we can obtain this formula from other side. It is using differential equation. Uh-huh. So we can consider the differential equation, and it is like the speed, yes, the changing of amount t, the speed of changing is proportional the interest rate and amount at the time t, and amount at the time t. And how we can solve this equation? Who would like to say how we can? Maybe Ivan? No?
I don't remember actually.
Oh, it is the bad sound. I can't hear you.
Don't remember now actually.
You don't remember? Okay. Nastya?
I will do this with Wolfram Alpha to be
Oh, it's a good way.
honest.
It's a good way. Okay. Okay. So it is a differential equation of the first order or the second order?
First,
First order. Okay. It's okay. But for the first order, what way for solving you know? For first order.
to take integral or
Yes, maybe to take integral. It is yes, it is like common approach. Yes, common approach. We would like to take integral, but we have if we take integral, you see the differential and the numerator and denominator. What can we do
Maybe we
first?
can use central difference formula for left side, and then we have
Central different. What
yeah,
do you mean?
like numeric approach, like
Numerical approach. No. It is like an analytical. I would like analytical. No, first we say that we can't use the integrating if we have differential in the numerator and denominator. What we can do?
we can move all AT to one side and another
Yes.
to another side.
Yes. Okay. Really to divide, yes, this variable. So we can write this like dA. No, first it is to multiply both sides by dt, yes, by dt, and after that to divide by 80, yes, the
Yes.
80 divided by 80, and these are multiplied dt. Okay, and after that, yes, really to take integral, and in this both it will be what it will be dA divided by a, dx divided by x.
1.
No.
Is it x square? A square? No.
No, please. The x divided by x. No, maybe you can have a look in Wikipedia.
It's equal to logarithm x.
Yes, it's ln. No, in this case, it's
ln, yes.
natural ln at. Maybe this absolute value, yes. In this case, it will be r. R, it is like constant before integral, but integral from dt, it will be t, yes? And plus constant. We can write this like lnc. After that, we can move this lnc to the left side, and it will be ln at divided by c equal rt, and after that this at divided by c equals what I should write? No, this value under logarithm equals, do you remember?
Exponenta.
To the power
RT.
RT, yes, okay, thank you. And from this we have a sub t equals c multiplied e to the power rt, yes. But we have the Cauchy problem, so we have if t equals 0, a equals a0. So if t equals 0, yes, 0, so a 0, instead t I write 0, c and e to the power 0, yes, e to the power 0, but it's 1. It is 1. It is 1. So c equals our 0. So in this formula, instead c, I need to write a0. So I have formula at equals a0, no, instead c, yes, multiplied e to the power rt. So I have the same formula. No, on this example, you can see the connection between differential equation and the continuous interest rates, the key finance objects. Okay. What is interesting, maybe useful, that sometimes we can take integral from, for example, from 0 to 5. If we have, if we need to compute something for 5 years, it may be from 0 to 5, or from 3 for 5. So it will be at your home task. So remember, please. Okay, clear. And go and no, and go on. Okay. Okay. No, on this example, we don't use all this formula. We only suppose that you own 20 euros in your pocket, and you have decided to deposit in 1 year. So you open your bank account and to deposit this euros, and at the end of year will be, so it is 20 euros at the end of at the start of the year. So at the end of the year it will be, no, it is what do you want? The result will be the same. We can use the simple interest rate, the compound interest rate, continuously interest rate. It will be a result no, almost the same for simple and compound, the same exactly. So what I need to write at the end of year, please assume any compounding.
0.1.
It is 0.1, it is like result, yes?
Mm-hmm.
So it is you multiplied the 20 by 20, да? Multiplied 1 plus
1.05.
Да, 1 plus R. 1 plus
Yes.
R, it is 0.05, yes. So it is so it will be, you check 20.1 or 21.0 multiplied to 2
I'm sorry, yes.
yes
21.
21. It is not this, it is this. It will be it will be 21, yes, at the end of year. No, and interest rate, we know interest rate. If we are speaking about profit, it is it is just €1, yes. Is it risky? We count that it's not risky. No, in common situation, yes, in common situation, it's not risky. We can predict that it will be this result, but in this situation, can we raise the profit? Can we raise? No, yes, only if we find the bank where that interest rate will be more, or if we own more, yes, amount than this. But from this input data, €20, and these are we can't raise the profit. And what do I mean in this situation? I mean that I don't have possibility. I don't to borrow in bank. Yes, because it's not profitable. No. Even if we assume that the R will be the same. Understand this, yes? So it's not risky, but we don't have possibility to raise, to scale this profit by borrowing in the bank. Okay, so not risky, but it's nothing. The second possibility, it is to buy risky financial instrument, risky securities, for example, stock. Stock is security representing value ownership that can be converted into cash. What does mean that this shares? No, shares, it is the same like stocks, but shares, it is like minimal unit. So I can choose, for example, stocks of the Coca-Cola company, but if I would like to buy two stocks, I can say, please, I would like to buy 2 shares, stocks of the Coca-Cola company, but if we are speaking about amount, we use shares, okay? And now we can do this on the site digitally. No, before we need to open your account with a broker helping. And if you bought for example, some shares of the some companies. So in your bank account, you can see a certificate of this. Maybe not in this form. It is the paper. It was before, but something like this. The price of the stock is very fluctuated, and it is at any given moment it is like a balance between supply and demand. So it is very risky instrument, very risky instrument. From mathematical point of view, what is interesting that the Louis Bachelier, it is French mathematics in this year, consider the stock prices like stochastic processes. Yes, the market price of stocks is very fluctuated. Yes, you see that the price is changing even not every day, but every hour, maybe every minute. But the price change on the little amount, and it looks like the demand of chance draw a random number and add it to the current price to determine the next price. Okay. So the second opportunities which we propose for investors, it is to invest your money in risky asset. And assumption the same, that you own only 20 euros, but you have decided to invest in risky asset, for example, Google stock. And now the price for Google stock is 175. But we have only 20 euros. So we need to borrow, yes? To borrow from bank 155, yes? And after that, at the end of period, we need to repay this debt. Okay. And the next assumption will be the time period for all these examples is 1 year. Okay. So the next our assumption is that we have only two scenarios. It is a so-called binomial model. Binomial, no, B, it means that only two scenario. The price can or to go up or goes down. Okay, and we need net profit for both scenario. For the up scenario, what can we say? What can we say? That at the end of period, yes, we have 200 euros. Yes, 200 euros. But it is not our profit because we need to repay how much? We need to repay this, yes? This price.
Yes,
Multiplied 100 multiplied 0.
if we borrow
Zero.
from bank.
Yes,
Five.
because it was borrow from bank. Yes, we need.
No, Elena, I think
Ah.
want to say that we borrow 155 just because we 20.
155. Okay, thank you. You're right. Because the sound was bad. Okay. And yes, and it will be profit if we find this difference. But for a net profit, we need to subtract our 20 euros too, yes? So it will be this 155. It will be 162, yes, 0.75. Okay, and the result is 17. Okay, it's not. The result is 17.25. Yes, it's like net profit. Okay. And what you can say, it's good result?
At least not bad.
Yes, it's not bad. Not bad. It's really not bad because we own only 20 euros, yes, and our net profit it is 17, not 1 euro like in the first example when we invest in bank account, not one, but 17. It is like 17.25 divided by 20. It is approximately 86%. Yes. So profit 86%. It's very good. Okay. But we need to consider the down scenario. But in down scenario will be 150 minus this 162 and minus 20, and the result will be less than 0, so it will be not profit, it is our loss. Yes. And if we have not one shares but 10 shares, it is terrible situation. So the question is to invest or not to invest. Okay. Yes, you know the situation from films, movies, and so on. Okay, so so it's very risky, but we really can raise the profit because we can borrow in the bank not only 155, yes, but 155 multiplies 10 or 100. It is like you want, up to you. How much you want to borrow in the bank, but you can be sure of what from this scenario will be in the future. Yes, so it's very risky, so summary, we can say that really we can raise the profit, but it's very risky instrument, and without to invest or not to invest in the stocks. Okay. The question now is how we can eliminate risk, reduce risk. How we can reduce risk? There are some ways, but maybe you know something.
Invest in different stock, diversify.
Yes, diversification of portfolio. Yes, it is especially for reducing risk, and it can be the topic for our studying at the end of this course. But today we would like to consider other possibility, not and its possibility not to borrow in bank this money, but to use derivative financial instruments. And now I am going to explain how it's possible. Okay, what is derivatives? Derivatives are contracts, agreements between two parties, a buyer and a seller, no, whose price is depends on the underlying assets. And there are a lot of different kinds of derivatives, forward, futures, swaps, and options. In this course, we are focusing on the option, but about all this possibility, you can write in the handbook on the do John Hull. A few words about forwards. It is this: forwards, futures, options. Forward, futures, about forwards. No, a forward contract. It is the thing what we used what we used to think about the agreement at common situation. A foreign contract gives the buyer the right and also obligation, yes, to purchase a specified amount of commodity at a specified time at a specified price. For example, gold or something other. So it's usually things. We are interested about what is long and short position into this forward contract. A long position, it's position buyer. If we would like to if we buy, for example, if we bought, first you agree to buy, and after that we bought this. Sorry, it is not option, it is a forward contract. So you need only agree to buy, to buy. Okay, and there are a short position. It is the position of the other party if you agree to sell asset. Okay, in this case, but we don't know what will be in the future. So in your agreement, the price is K, but it can be more than K or less than K in the future. So if we have a long position, so your profit, it will be in the future S minus K. So for example, today it's 100 and will be 120, but you agree to buy for 100, yes? So other buy for 120, but you for 100. So it's really like your profit in 20 years. But if you have short position, it is in this situation, it is not profit, it's loss. Okay. What is forward contract? Forward contract, or what is futures? Futures. What is futures? It is very similar to forwards. It is, but there are some difference. forward, it is like private contract between two parties, but futures, it's exchange traded. It is forward not standard, it is standard on the exchange. It is usually one specified delivery date, but in this case, it's a range of delivery dates. It is settled only at the end of contract, it is settled daily. And this, we have some credit risk. For example, we signed this agreement, but we are not sure that at the end of the period, the other party said, I don't want to commit this. Yes, and you need to do something, maybe to have a lawyer and something else. But for futures, virtually no credit risk, because you work on the stock exchange. Okay, and the main our instruments for today, it is options. We can have options not only on the stock, but on the other primary active, but mostly it is option on the stock. A stock option is a contract too between a buyer and seller. But what is difference? The buyer of the option gets the right to buy or sell the underlying stock, but the buyer of the option isn't obligated to buy or sell the underlying stocks. Yes, the buyer will only do this when it's profitable. What does it mean? It means that if it is like lottery tickets, understand? You have lottery tickets, but if it's not profitable, we don't use this lottery tickets. So we have the next elements of stock prices. No, maybe you understand that it's not free agreement like forward or futures. Yes. The price of the option known as a premium, and we can denote this like C or P. The predetermined price known as the strike price or the exercise price. The stock price on the market price is S from T, and the expiration data T. So it is elements of the stock options, and you need to know and to understand it even for the kind of mathematics we will involve later. Okay, and on this picture, I would like to show you how we can do this digitally. Okay, we can open NASDAQ. Yes, really, it is NASDAQ. After that, we need to choose, yes, simple search, what I would like. In my example, it was Google. Google, Google. I don't know what is from this Google, but anyway, okay. And what we can see, it is that the prices of stocks is very fluctuated. Yes, it is price for today, 187. And if we would like to buy option, we need to find what option. You see, option chain. And you see this table. You see this table. Today the price 187. This we can choose the date. No, okay, even February, not for example February 21. And in the middle, in green color, you can see strike prices. Strike prices. Today it is 187. 187. Yes. And what is our aim? For example, okay, in green color, it is strike price. It is what price? It is this price what is determined in your option. And in the first column, you can see the premium of the option. For example, if I would like if today I would like to buy on this date, for example, today I don't have money, yes, and I would like to buy in this date. So, for example, I pay premium 4.4, and on this date, February 21, I can buy these shares for this price. Okay, it is the first possibility of the option, but the main possibility it is like speculation. So we buy option for profit, not for holding these stocks. Yes, and we need to guess that the price in the future will be more than this strike price. So first we need to guess strike price, and that the prices in the future will be more. If we are speaking about call option, I understand that maybe now it's not clear everything. It's okay, it's normal. I need to explain from other sides. So it is like the similar table, and so it is this site Nasdaq, Google stocks for today. No, this, for example, and we buy option with strike price in 1 year 170. Okay, so if the market price in 1 year will be 200, so our payoff, our profit will be 200 minus 170. Yes, so our profit, it is this difference. We need to guess this strike price, because you see that we can choose any strike price. Yes, any strike price. But if we choose strike price less than than today, for example, it's very expensive. So we need to pay attention everything. It is our payoff. This difference, but it's not net profit, because we need to subtract premium. Yes, if we buy for 117, so it is the price premium of this option we need to pay to 9.6. Okay, 9.6. Maybe now the next example, and maybe after that will be more clear. Okay, our example, we continue. You remember that you own 20 euros and you would like to earn as before. You have decided to invest not in the Google stocks, but in the call option on the Google stock with strike 170. Premium is 9.60. But we can to pay this money because we own 20 euros, yes? And what is very good, that you don't need to borrow in the bank money to buy the Google stocks, because it is like agreement, like a lottery ticket. But it is risky too, because we don't know the price of option, the price of Google stock in 1 year. And the assumption, like in previous example, it is the price today, and there are two scenarios. A price can go up and go down, and if this go up, it will be 200. So the price in 1 year is 200, but strike price 117. So what is our profit? Федір.
Yes, we should 20 minus 170 and minus 9.6.
Yes, yes, thank you. 200 minus this strike price. So it is S, you see S, yes, it is market price minus strike price. Minus strike price, yes? Minus strike price. It's called payoff. Payoff.
Yes.
Yes, payoff. You can write this like payoff. But for net profit, we need subtract premium 9.6. So, and it will be net profit. Net profit.
It's 20.4.
Thank you. 20, yes?
Yes.
20.4. It's not very good, no, profit, yes, but it's something.
If I'm not mistaken, it's still better than if we buy just stock that go up to 20.
Yes. But what is about this scenario? Who would like to say what is about this scenario? How do you understand the benefits? The benefits of option. Okay, Fedor, continue.
Here we just lose 9.6 euros because we.
Yes, because we don't need to realize this option. It is like a lottery ticket which didn't win. We didn't win. We don't exercise. We don't have losses. Yes, so payoff will be zero. Only zero. We don't realize. It is payoff, yes. But we paid 9.6, so it is net profit, it is losses minus 9.6, okay? So it is very important, and you need to remember that in the down scenario, you don't need to realize option. So it is payoff is zero, and we can write this like the payoff function equals s minus k with plus. No, it is like these brackets or these brackets. No, it was plus, and it means that we have the up scenario as s minus k, and at the down scenario we can zero. Okay. So is it risky? Yes, it is risky because in the up scenario we have net profit. In the down scenario we have loss. But this risk, these losses are limited. But if we trade by stocks, our losses are unlimited. But in this case, it's limited, and we know about this in advance. Yes. Okay. No, maybe every time we will be speak about option and will be more clear all of these benefits of this option. Okay. And these graphs about call options, because we considered only call options. Put options will be opposite. Okay, now about call option. Long position. If we buy the option and we are waiting, and it is a long period, so it's long position, a long position. And we know already that a call option will be exercised when the stock price is above the strike, if it is as more than K, because if it is less than K, we don't need to realize, and payoff will be zero. Yes, will be zero. But net profit in this situation will be not zero, but will be minus premium. Premium in this situation $10. So it will be minus $10 until 100, until 100. Yes, if it is 100, so it is how it's called, it is a break even. After that we have, if the price more than 100, we have profit. If the price 110, the profit is 110 minus 100, so it is 10. Yes, if it is 120, profit is 20, and so on. But if we are speaking about net profit, so we need to subtract 10. So for example, if 120 minus 100, the profit 20, but minus 10, it is just 10. Yes, so if we write this mathematically, so net profit, it is S minus K, it is market price minus strike price, it is 100, E minus premium, and it is if S more than K. But if it is less than K, so it's minus P, and it is early to draw. Yes, minus P, it is this, and S minus K minus P minus K minus P, it is like constant, so it is S minus constant. It is S, it is bisectors, and this, it is like moved on this constant. You understand? But what is about it is it is what buy position. It was position for you or me if we buy option. But if it is company which issue this this option, so it is the opposite situation, because the stock price less than 100, they have profit, and it is profit. It is because we pay premium. Yes, we pay premium. And they don't need pay off as minus K because it's not this. But if the market price will be more than K, they need to pay. They need to pay. So their profit is less and less, and it is this line. The similar situation, but opposite with put option. It's long position and short position. Okay. And now we have a little of time, but okay. All that I told you today, it was about European option. But there are American option. American option can be exercised on or before the expiration date. And it will be later about this American option. So summary, we can say that the key object is of the finance in our excursion. It is financial markets, and financial markets exist because they provide efficiently allocation resources across time and states of nature. We can consider non-risky primary financial instruments. It is bank account and bonds. That's all. Their price depends only on time, not on the chance. So the kind of mathematics for describing this, it is simple, compound, and continuous interest rate. Okay, we have risky primary financial instruments. It is stocks or shares. It is the same. The market prices of the stocks is very fluctuated and can be described by a stochastic process. And so the our subject is called not only financial mathematics, but stochastic financial mathematics. Yes, because of this. And we need to distinguish derivative financial instrument. Their price derived from underlying assets. It is forwards, futures, and options. All these derivatives are used to raise capital and to reduce risk. Yes. In this course, we need to compute, to evaluate a fair price of the option, because we can see this price on the we can see this price. We can see this price, yes, on this side, but we are not sure that this price, for example, if we choose this strike price, we see that the premium is 4, but we don't. We are not sure that this price are fair price. And sorry. Yes, so a fair price is the main one of the main problem of the financial mathematics. And about our grading, so we have 12 or 13 lectures, but we have tested after lecture after 12 lectures. So our test is 2 scores. So we have 24 scores for grading. We have problem set, it is 6 units. We have input test, individual task, and final test. Okay, and it is the reference and your literature for today's lectures. And what I would like to say that that at 3 p.m. we have the practice lesson, but I propose to explain and what will be before, because I'm planning to give you the input test. Do you remember this? Where is this? Input test.
Но я еще один нашел, ты знаешь? Чего?
Input test. Input test on this to do this, okay? Can you see? Yes, okay. It is your task for practice lesson. So we can don't meet. We can not meet on the practice lesson. Yes, because it is your task for today's practice lesson. But I need to repeat what you need after today's lecture. After today's lecture, we need to do this test. It is a test about a lecture. On the practice lesson, we need to do input test, and the deadline for this test is today, the end of this day, but the deadline for the input test and for this problem set is the next week. Next week, it is 1 week. Okay, it's 1 week. On the next week will be the second lecture, and on the practical lesson we will be check how we understand, how we manage with this problem set, and you will have the possibility to correct your problem set. The main thing is to upload this in time. Okay? Okay.
Okay.
Have you any questions?
Not yet.
Not yet. It's very good. It's very good. I wish you good luck on your practice lesson with the input test and with the test after lesson. It is like crossword. Okay, and till the next week. See you next week.
Thank you.
Thank you.
Thank you.
Thank you.
Bye.
Bye.
Bye bye, butterfly. See you later, alligator. Bye.
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 И разбирается в политике.